Good afternoon. This is Tom Alexander. It is Sunday, July 17th. It is about 1:08 p.m. Eastern Time in beautiful Charleston, South Carolina. And a lot to discuss this week. It's possible we have an important low in place and that we are on the cusp of the most significant rally that we've seen since the January top. Now, there are a lot of, as usual, if and or buts. So let's dive into this weekend's report and we'll discuss some of those and we'll lay out a potential path for next week. By the way, housekeeping, this is the video addendum to the written report that I send out every week. If you did not receive a written report and you're getting this video, great. But if you want the written report, please send me an email to tom@alexandertrade.com. Say you want the report, I'll put you on the list. Also, if you're watching this video, it would be a tremendous help to me that if you do like it, if you will like it, and if you would like to receive notifications, press the notification bell and you can subscribe. That would be a big help. Okay, let's dive into the report now. I guess we are looking at the screen. Here we go. Okay, so here are the four primary U.S. trading indices. These are the cash markets. And you can see we're really between critical levels. I consider last week's low now a critical level because I think if that's taken out, you're going to see one or more of the U.S. indices trade below the June low, which is the important low, intermediate term. This recent last low is, I think it's important to the immediate bullish case. Now, if you notice at the June low, we had these minor divergences that occurred among the indices. And I pointed this out at the time. They were minor, but they were there. And you almost always get this type of divergence at significant stock market turns. You have divergences among these four primary trading indices. Sometimes it's different. But they're almost always there. Now, the problem with that is you have to be careful because sometimes there are false signals where there is a divergence and then suddenly within a few days, there's no longer a divergence and everything is moving in lockstep to the up or down. Which brings me to another point. I don't want to go too far off on the tangent here, which I want to do, but when the stock market trends, the indices are so highly correlated now. We're in such a highly correlated world, the way money is managed now, that when there is a significant trend, one sign of that trend being healthy is when all four of these indices are moving in lockstep together, even if they aren't simultaneously taking out critical levels. But for instance, if we're up big on Monday, and let's say the NDX takes out this recent high because it's the closest one to the upper extreme of this key reference area, it does, and the others don't. Well, you have to give it a little bit of time. Another day or two to see if everything confirms, but you should see on a strong up day everything moving in lockstep together. You will almost always see that. Okay, let's take a look at, I'm just going to highlight the SPX, and this is certainly in the report. And what I've done here is give the retracement percentages of rallies off of this January high. And this was almost 9%. This was about 12.7. This was 9.7. And then this rally that really formed this key reference area was tested here was about 8.6%. Well, what I have done is taken the 9.7%, which was the second strongest rally we've seen. And if we were to rally 9.7% from this low, then we would top out around 4,000. Now that 4,000 is a round number. You always see the round numbers being predicted by various methods and all this other stuff. So it's sort of coincidental that that's 4,000. Now, the 12.7 number hits around 4,100. Again, a round number. Now, to me, the most important level, if we trade up in here, I think it's likely that we trade higher. If we trade to 4,000, now maybe there's some short-term pushback, maybe there's some short-term pushback from in here, but I think we're going to see an attempt to trade through this level for a variety of reasons. Could be wrong, and we'll certainly update this in real time as each day passes, but I'm not going to be a bit surprised to see this 9.7 level exceeded. And I really think that the more interesting level is this level right in here, the 4,100 to 4,150 level. And if this is reached, it will be quite interesting. Okay, let's take a look at the profile view. And each week, I put a path of what I feel could be a path of development from a market profile, auction market perspective. And the path, let me get my drawing tool here, that I think we could be following. I think there are two probable paths. One is, this is where we're trading as of the close. So I think that this is a potential that we form this balance area, this Gaussian looking shape here. On the other hand, wouldn't be shocked to see this important low hold and we trade higher over the next, I don't know, week plus like this. So I don't really have, if we close below Friday session lows, cash lows, and all the indices, then it opens up all sorts of possibilities. And if that happens, I will update that at that point in time. But I think those two scenarios are viable. Okay, from a technical perspective, okay, we landed on VIX, the SPX VIX base. So I'll just go with it first. I've been saying for a number of weeks, and this is no big revelation, that if VIX continues to drop, the market is likely to rise. And if VIX continues to drop at this point, the market could actually accelerate higher. So that's additional evidence on the sign of this level potentially being blown through. And we'll see. That remains to be seen. But this is going to be an important level. We want to be watching VIX if and when that happens. As long as VIX is declining, the rally is extremely likely to continue. Now let's take a look at breadth. Now the green arrows highlight days on which we had negative NYSE closing breadth of negative 2,000 or greater. And there have been, since the January top, an extraordinary number of those days. Since the end of March top, this is almost unprecedented, the number of negative 2,000 breadth readings that we've seen since that March top. Now, that seems to have abated somewhat. We have gone now a month without a negative 2,000 breadth reading. Something else that is interesting that we will be watching if we have a bullish market at the moment, short term, we're going to begin to see these breadth days more than one back to back. We have not had, and I hadn't realized that until I was looking at it this weekend, we haven't had consecutive positive breadth days since the end of May. That's, I haven't done any homework on that, but that's unusual. It just shows how persistent the selling has been. We certainly have had a bear market signature in breadth, and I'm going to talk about that further in just a minute. But if my present bullish lean is correct, and I'm leaning bullishly as we head into Sunday glowbacks, we head into the cash open, then we should see could very easily see another strong up day on Monday. It certainly should be a positive up day, and then potentially even Tuesday, Wednesday. That's something that has not occurred. We haven't had 3 consecutive up breadth days since, well, the end of May. Okay, another thing I want to show you about breadth, and this is intraday stuff. All right, this is a 30-minute chart. This is a 30-minute chart of the ES. It's day session only, so this is the cash market. Below this is breadth. And as I put in the report, breadth has a very different signature in a bear trend versus a bull trend. And in a bear trend, it will reach an upper extreme, and that will cap rallies. You might get a little more price action to the upside, but not much. And the market will quickly resume its downtrend and in most cases make lower lows before there's anything resembling an attempt at a rally. So this is where we are. Now, if this market is bearish, continues bearish, and we're not going to get a surprise to the upside, this is it. This is as much as you're going to see. You're only going to see this level reached, and then you're going to get this big crater again like we saw over here. We've seen many times in the past. That's a possibility. I do think we will reach up in here. We shall see, and that's predicated on Friday's lows holding. But if this is not different this time, then this may cap this rally, and then we get another shot and at least test these recent lows from last week. Now, I want to go back and show you, and this is in the report. If, however, we're on the cusp of a larger rally that rivals the largest rally that we've seen since the January high, we're likely to see something like this. Breadth got extreme here, plus 2,000 reading. And while breadth was weak for the next couple of weeks, we still had a barn burning rally of 6.6% before the market began its downtrend again. So I think we're going to find out Monday, actually, which is more likely, whether we're going to get that extended rally above the key reference area, the closest key reference area, which is right here, or if this is going to cap it and we're just going to trade back down lower and maybe test last week's lows and potentially even make lower lows. Guys, I hope you found this useful. Enjoy the rest of your weekend, and I'll update again soon.